what I'm going to try and do is take you through a journey of the 30 years that have happened to date of the RPS, a little bit then of where we are today and hopefully what the future will bring for us. But first of all, let me introduce myself. So I think many of will know I've been in this role for just about 5 years, but prior to that I was a trustee, and I can nearly tick all the boxes that Christine does. I'm not yet a pensioner, but I will be retiring next year, so that will come as well. But I obviously have been an employer with First Group. I've been on pension committees. I was a trustee from 2007, and then I was chair of the investment committee, then ultimately chair of the trustee board. So I bring a sort of wealth and richness of experience that hopefully will bring out some of today. In my spare time, I also chair the policy board of the Pensions and Lifetime Savings Association. So that's very important for Railpen and for the RPS, because actually legislation and regulation that goes on around us can have significant influences. And you'll see some of those as we look back through the 30 years. But really what we like to do now is just take you on a little bit of a journey, that slide works, into a 30-year history of the RPS. And what I'm going to do is I'm going to illustrate this with some numbers. I think that's quite useful. So we'll remember October 1994, and we saw privatisation. Now, at that point, effectively, what was the old BR structure of divisions was transported across. So we had a rail scheme with one set of benefit designs and, 6 sections. And in fact, we had 8 managers at that sort of point. So it was really low numbers. We created our first set of accounts in 1995, and they were 45 pages typewritten. So none of this lovely proof setting that Jonathan and his wider teams do today. And we looked at that, there were 28 sections by then. So we were seeing as privatisation, it didn't happen as a big bang, it happened over time as train operating companies were let, and that was the start of that growth. To put in context though, December 22, it's up there in pages, 127 pages in very small font, over 100 sections. So quite radical change that's happened. And we've seen that, and I'll talk about why we've led to that and what's happened. Christine talked about DC. The industry-wide DC scheme was formed in 2001, so it's been around for quite a long time. But even today, it's not one of our bigger sections. It still has relatively modest take-up because we've been able to preserve through the continual negotiation and re-evaluation at each valuation point, the funding of the scheme, and by amending benefits to keep the scheme open. And that's really important because DB schemes do provide the best benefits for our members. Let me talk about membership. So when you look at the membership today, what you can clearly see is it's been going up ever since inception. Now, instinctively, that wasn't how I expected the graph to look. And when you look at the orange bars, active members are not very much different. What we have seen is pensioners are very similar. It's the deferreds, that people who work a smaller amount of time in the industry and then move to something else, has been the thing that's really moved up. But actually that demonstrates that since privatisation, actually relatively there's been success. We haven't seen a decline in membership. I think you'd all recognise that from the businesses you're in. When I look at investments, what's clear here is we've seen quite a change over the duration. I've just put in 5-year numbers here of how many managers we've had and what they've been doing. So you see in the early days, back in 1994-5, we had a lot of public managers. So these are people managing bonds and equities for us in particular. But over time, that's changed. And what you see, I've got that big ITP banner in the middle. And for those of you who've been around some time, who remembers who was in the rail industry in 2013? Not as many as I thought. So in 2013, when I was chairing the investment committee, we took a look at what was going on in terms of investment costs and just thought, are we getting the value we really want for our members at that point? And we were looking at the overall cost of provision and realised that actually it's cost us nearly 3% to get the investment return to manage those investments. So we took a view to say, let's radically reorganise this, change that structure. And what we did is we bought a lot of our assets internally. We select external managers when we really want to. And we really did a job on driving down costs. Now, today our costs are a little under 1%. So we're saving over 2% in costs. And 2% on 35 billion is about 700 million a year. That's a very big number. That matters. What you'll see, though, in those latter years is those big blue bars have changed. Those big blue bars are our private managers. These are people unlisted companies, ones where we'll own them or own a share of them. And the way that we want to access those is we invest through a fund, but we co-invest alongside that fund. And we do that because it gives us really efficient cost mechanisms. Because when we co-invest, we don't pay any fees. So that's one of the ways we've been able to drive down costs and still get return. Now, I'm going to give you the return figures now. So if you look at the numbers, you can see that the black line is how many pooled funds we have. And we arrange pooled funds deliberately because we've got 100 sections. We need to break it into chunks for you, and we provide a pooled fund. But when you look at the return, you'll see that really up to about 2009 or so, it's a modest increasing line, but not massive from the 10 billion we started with in 1994. The line has steepened since then. So it's a combination of running those in-house, getting those fee reductions from ITP. We've seen a real demonstration of value that comes from investment. And that investment is really, really important. When you look at the cost of running this scheme, your contributions make up 25p of every pension we pay out. 75 pence comes from the investments. So it's really important that we get that investment growth going forward. And the other reason that's important is that when you look at your bank account, this is benefit contributions and benefit payments out. So think of this. This is basically saying every year we spend more than we get in through contributions. Now, in any normal society, you just expect your bank balance to go down to zero. The reason it's gone up and those asset numbers were net of these negative cash flows is because we've been able to generate such good return that we haven't needed to ask for lots more cash from contributions. And that's one of the reasons the schemes have been able to continue for as long as they have. And this just gives you an illustration on a 5-year matrix, just showing that the gap in any single year can be over £500 million of extra benefits paid out versus the contributions we get from membership. And obviously, not all sections are the same. We know we've got the 94 pension sections that effectively have never had contributions coming in. They're just paying out the benefits as they're due. So what I wanted to do now is put in context what has happened in the 30 years since the RPS was formed. And there's an enormous amount. So this is where my thumb's going to get rather tired as I click through this. There's a number of things that are going to come up I'm not going to talk about because there are so many. But this is just to give you an illustration of how many things have changed. And I'll pick out a couple. So I'll pick out 2005, FRS 17. That was effectively when companies were forced to put all their pension liabilities on their balance sheet, on the P&L. That, in my mind, was the start of the death of defined benefit pension plans. That's when companies and CFOs said, God, I can't take that volatility anymore. And that was the drive towards DC. Now, we're quite lucky that our train operating companies don't have to deal with that in quite the same way, but it has been a major hurdle for DB. We look at 1997, pensionable pay restructuring. Why did that come around? I'm going to blame Christine. She was responsible for that. That was done so that actually we could look at pay and consolidate many of these allowances and put them together without having a massive impact on the past services of the pension plan. So it was a very sensible thing to do, but that has driven the complexity that in Nick Cromac's world has made life really difficult going forward. We have individuals who have 23 different definitions of pensionable pay or different amounts. That's hard. Let's click forward a few more. 2006, scheme-specific funding. Now, for me, this was one of the big things that really mattered. Because up until that point, effectively, we treated the Railways pension scheme as just one scheme, not 100 sections. We gave it one discount rate. We invested in very, very similar ways. In 2006, what happened was the legislation said, we need to amend this. You need to reflect the strength of your employer. Covenant assessment was born. You need to look at the specific discount rate based upon the duration and maturity of your plan, and you need to invest according to that. So suddenly we went from quite a straightforward model to saying, actually, we need to build the capability to consult on all these things. And that was the first valuation in 2007, where we came out with our famous 100-page consultation document. Because it was required for the first time. So suddenly the workload that went into the team now run by Jules and Peter and others was expanded enormously. Again, further complexity, unfortunately, further cost. We see the global financial crisis and various other things. Let's move forward a little bit more. So 2018, DC Master Trust authorization. The industry-wide DC scheme that's been running since 2001, suddenly we have to comply with master trust regulations. This is when auto-enrollment was starting. We saw things like Nest, the People's Pension, all coming along. What did that mean for us? Well, first of all, we had to write a 4,500-page submission document. And we are forced into a compliance regime that is incredibly burdensome. Sometimes we have to report things within 1 day of them happening, 1 day, 5 days, 7 days. Again, further overhead designed to protect the pensions infrastructure, but actually just making it more complicated from an administrative and a compliance burden. And then we move forward a little bit further. We all remember COVID, very sadly. Then we remember pensions dashboard, and we'll hear Richard talking about that with Martin later. But one of the best things to happen to pensions was the Quarten Trust guilt crisis, whatever you want to call it. Actually, for most pension schemes, this was fantastic, and particularly good for the RPS. We saw funding levels rise markedly at that point in time, which was a great position. And fortunately, we're in the position where we could lock many of those in, particularly for closed sections that don't have an unlimited time to get their funding up to a position. So that, for us, while there was a lot of noise in the market about this is a disaster, pension schemes are going bankrupt, they were never going bankrupt. They had liquidity challenges, but actually it was a really positive thing for a lot of pension schemes and for the industry. It's one of the reasons that the RPS is generally in as good health as it is today. And finally, we have the DB funding code. That is just coming in. And when we look at that, that is what we are sort of dealing with in the last valuation. For those of you that got closed sections, you might recognize that we started valuing on a second balance sheet. That is to consider the DB funding code coming in. So recognizing that as schemes get more mature, they can't afford to take as much risk. They need to de-risk so that they have that security for members. Because as Christine said, what we're trying to do is make sure that we have that affordability maintained, the security maintained, and we managed all that in the round, and that hopefully will do that. Now, it's not quite there yet, but we have a pretty good view, and Tim might talk about this later about what will happen. So what does that mean today for us? Well, let's talk about it. So we have 3 types of scheme in my mind. We've got those immature schemes, the open schemes, largely places like TOC, Network Rail, where we have a long time horizon to when we have sort of accrual stopping or the last pensioner. So those ones, basically, we are investing very heavily in growth assets, getting that return we need to keep the costs affordable and to keep the things running for a long time. The second group we have is maturing sections. So those are those that closed recently. And where they are is they're starting like the open sections, but over time, we will see them take that risk off the table. And finally, we have the very mature closed sections that have been closed sometime. We're actually just locking down the risk, trying to ensure that we don't create a big deficit for the remaining members that are still being up service or the employer, and getting those right. And for that last group, what's really important, and we'll have those discussions going forward, is what's going to be the end game for those people? Do they just run off until the last pensioner dies, or actually do they want to transact with an insurance company and lock away the benefits for members and secure those? Because from a trustee's point of view, what they want to do is secure those members' benefits, make sure they're paid out in full. What's the best way of achieving that? When we look at the funding position, this is the estimates at the end of 2023, so 1 year after the valuation, and this is basically in very rude health. The vast majority are to the right-hand side of 100, so over 100% funded. The ones that aren't in this 90 to 100 group are generally sections who are on a second balance sheet. So they're assuming that de-risking. So they would have been over here. The second balance sheet has moved them down a little bit, but they're in a very good position. And there's only 6 that are left below 90. So in my time as a trustee and as Railpen's CEO, this is the best it's ever been, to be honest. So it's a great job that's been done. As I say, we've been able to lock in many of those benefits. We've got many new initiatives in terms of pooled funds and liability-driven investing, particularly for those mature funds that the trustee has taken forward. Let's talk about administration, though. Administration has suffered. All those changes that have happened over the last 30 years have had an impact on administration. Rightly, we've adjusted benefits to make the scheme affordable going forward. But effectively, that means we have over 700 different benefit structures across our schemes. Now, when you think about it, 100 sections, 700 benefit structures, that shows the complexity. And then you've got PRP with individuals with 23 different definitions of pensionable pay. It's hard. And it makes it really hard for those who actually doing the calcs on seeing them come out, because it's so difficult to work it out. In the old days of defined benefit, if you worked for a company for 40 years, that was the top one. it was a 60th scheme, you divided by 60, that's 2/3, you multiplied by your final salary, and that was your pension. It's not like that anymore. We have very few final salary pension plans left within the rail scheme. Most of them are effectively a hybrid scheme that has some sort of career average elements, whether it's through PRP or whether it's through a formal care structure. What does this mean, though? Well, effectively, it means for some people, we can't even calculate their benefit automatically. And as we get increasingly small cohorts, so for instance, those with protections that might decide to waive their protection because they're already 60, so they don't need the right to retire at 60 because they're going to go at 65, why pay more? They waive that. And we've got such small groups that actually it's becoming impossible for us to want to code this into the system. The costs of coding it outweigh the benefits. So in many cases, there are manual reversions on these. And we have to remember the context, and this is very important when we are talking to the government about this, about pensions policy, is that this is not a fat cat scheme. When you compare this to many of the civil service and other DB schemes, because of the offset we have at the bottom, this is not a massively generous benefit. It's still a much better benefit than DC. But when people say gold plated, I always shoot them down and say, that's not what this is. This is a good pension, but it's not gold plated. The average pension we currently pay out is £150 per week. So just quickly onto investments, about 35 billion. Number's gone up a lot. It fluctuates on a daily basis. Sometimes within a week, it fluctuates by over £500 million. We expect that. That's noise. We don't respond and try and time things. It's really hard to do that. And we've got these pooled funds I talked about. And those pooled funds are being designed to give you as clients the tools you need. And we have pooled funds, and there'll be more on this later, I expect, that really are designed to do a job. A growth pooled fund that is all about sort of, yes, people who need growth. Sort of a matching pool fund with LDI, some long-term income funds for these cash flow generation. So designed to do that and trying to make it not too complicated for the job we have to do in talking to pensions committees and employers. What we've seen today is around 65% of our assets are now internally managed by a team sitting on the 7th floor. The other 35 are spread out with a number of variety of different managers. And the basic premise for that is those assets that we think we are always going to be running these equities, we'll build the team internally. Those that we think will run for a while and then we won't, and then we'll come back in, those are the ones we externalize. Or where the risk of doing it is so extreme, we just don't want to do it internally. We don't feel we can take that risk at the moment. So that's roughly the balance. It changes over time, but we're reflective and we look at how well we're performing to say, if we're not performing well enough, we need to do the right thing and say, let's give it to somebody else to do. So I'm going to move on to my look forward, but I'm going to allow you a few minutes for questions at the end. So if there are any people that are thinking, I didn't understand what John said, or I'd like more clarity, or you want to ask me anything else, then I will give you that opportunity, just to give you a bit of advance warning. So what could be happening next? Well, overall, I think we're really well positioned. The funding positions mean that actually we're in a good place. Most of the valuations went through relatively easily this year without the need for benefit changes. And I hope from Nick's point of view, we don't have lots of benefit changes in the next valuation as well, because that makes our life a lot easier. Every time we have a benefit change, it's another few benefit structures. So that's important. The strong funding positions will hopefully protect us against that and also give us a little bit of buffer against if there are bad times going up to 2025, because as soon as we get through one valuation, we're almost straight onto the next one. Complexity is an issue, though. Christine's touched again on it. You'll hear it later. We have to find ways to try and eliminate complexity, or at least stop complexity growing in the future. And I'll talk about this in my takeaways in a couple of seconds. And then increasingly what we're going to see is two distinct cohorts. We're going to see the middle group that were ones that were recently closed will start moving towards the ones that have been closed for some time. So we're going to see open, and that's probably for us a cohort of about 40 sections. And we're going to see closed, which is a cohort of about 70 sections. And of course, we're always aware that the government has got a lot of consultations out. And one of their consultations out at the moment is about how can you consolidate? They recognise that most DB plans are getting smaller. Same with DC. They want scale. One, it makes it easier for the regulation to happen. But second, it also provides great efficiency in terms of investment. If you're trying to invest a £10 million fund, you basically don't get much value. and you've got lots of overhead and lots of governance that needs to be done. When you've got big funds, then you can do it really well. Now, the rail scheme's already there. That's how we were set up. We were set up so you get the economy of scale of having 35 billion, whether your own section is only 2 or 3. So that's million, and so that's very important. Let's look at the external factors that could be significant. So we look, rail industry change. We don't know what's going to happen. GBR, renationalisation, whatever happens, you've got to remember pension benefits earned in the past can't be changed. So the future might change. That might be positive. We could see a number of things there. We'll see the DB funding code come through. We're not expecting any surprises there, but who can tell how that might evolve? Things that were done with great intentions many years ago often tend to be the things that trip you up at some point in the future. Public sentiment is very important. At the moment, you'll probably recognise it feels a little bit like DB are considered the haves and DC, defined contribution, are considered the have-nots. And that's because basically not enough money is going into DC. There needs to be more. And there's a discussion around that. But it's a very hard political statement to say, I want to push up the cost by 4% and just force employers and members to pay that. So we will see pressure. We don't see it quite like they have in France around pensions, about, yes, what's the right model going forward? How does that work? If there were ever to be pressure on things like the civil service schemes and teachers and firemen to move away from DB, what would that mean for rail? So we have to be prepared for that. We're not hoping for it, but it's one of those things that could happen. Defunding of the scheme. So a few years ago, the Royal Mail scheme was given a government guarantee. So in other words, all your benefits are secure, but actually all the money moved back to the government, 28 billion. That could happen. They could take a view, particularly if there's a nationalisation of some or all of the sections, probably more aligned to Network Rail and TOCs. That's a risk that happens. If that happens, what Railpen looks like changes completely. And will we see any future standardisation? Depending on what the things above happen, will we see standard benefits going forward? That would make future administration more easy, but it doesn't change the fact that for Nick, she's all got these hundreds of legacy situations that we ended up with. So just to move on to my takeaways before we go to questions. So the first one is the scheme has become very complicated. Some of it is because we in this room have taken those actions to try and help us to get to a position where we can keep the scheme open. That's exactly what it was designed to do. That's what shared cost was all about. But also we've seen masses of regulatory and compliance changes. That timeline over 30 years, I don't expect that to stop now and be light touch. I expect that to continue. That is just the way things happen. So we will have more to face going forward. And that just makes us more complicated and acts to increase the costs. Now we're looking at ways where we can control costs, but it's not easy. But what I'd ask here is, if you are thinking about any changes to benefits, any structures, please talk to us early. Because when your advisor might come and say, oh, I'd like to put in this structure. Oh, it's okay. Loads of people do it. It's nice and straightforward. There's a good chance, one, we've already done something very, very similar. And if you don't, there's a danger it's new to us. And if it's new to us, we could be saying, right, we can do it, but it's going to cost this for you. We might be able to slide you into something that gives you 95% of those benefits with almost zero cost. And that would be preferable for anyway, because we're trying to, again, that just reduces the complexity. So it makes Nick's job manageable in the benefit side. So very important. Second thing is, if you have any issues or concerns, things that aren't working, don't bottle them up. Please come and talk to me, come and talk to Mads on investments, or Nick on benefits, other people you know, your client relationship managers, help us. Because if we don't know about the issues, we won't deal with them. So we see them occasionally, but please be upfront with us. It really helps. And finally, Railpen is not here to get in the way. Railpen is here to help. It's here to deliver. Our purpose is to secure our members' futures. That is really important, because that's why I get out of bed every morning. It's to make sure that the thousands of members that without this great scheme would have a very difficult retirement can retire with dignity and with what they expect.